Good morning. See, I remembered the mute button was on. We actually turned that off mute before we started talking this time. You know, every week is an adventure. And if you don't look at it as fun, well, you're just looking too hard. So I wanted to start out. I have my quote sitting right here in front of me. Megan and I were sitting here thinking about what is it that we're going to do differently? Did you realize that the end of the first half of the year is upon us? We are starting July, which is the second half of the year. It is amazing to me that it's already happened. And when I think about the next big thing, which happened at the end of January, that feels like it was years ago. This has been the strangest, longest, sometimes hardest first 6 months of the year. If you watch CNBC at all, or if you're paying attention to what's happening to your stocks, I'm sorry. They're talking about the fact that it's the worst first half of the year since 1970. We're all feeling like this first half of the year was intense with its twists and turns. So as that came up, I started thinking about the fact that I set goals. I do a annual retreat with my team. I take them somewhere really nice. We go up to the Four Seasons in Vail, or we go down, or we go over to the Gaylord, or we do something really big. We set these really big goals for the next year. And Megan and I were just talking about the fact that I think I have to throw all of them out the window and we have to kind of start over.
It's time to revamp because of the market shift.
So talking about setting up some time this weekend, even if it's just a couple of hours, carving away from the barbecues and the beer and the parties, and what is it that you want to accomplish this second half? What do you have to focus on? Is it more relationships, which is what Megan was saying?
Yep.
Is it working harder, different, smarter? Is it creating a new video strategy or marketing plan? Is it generating more business? Maybe it's less business. Maybe you want to start creating more life balance. Doesn't have to be about work, but what is it that you want to accomplish the second half of this year? Really kind of struck me this morning. Oh my gosh. And what a beautiful weather to be able to sit outside and have that time. So here's our quote. I can't not have the quote. And it kind of goes with this, because as you're carving out a little bit of time this weekend to think about what you want to accomplish these next 6 months, I would say don't limit yourself. Limited thinking gets you absolutely nowhere. Always dream big, think forward. Here it is. Overthinking is the biggest waste of human energy. Trust yourself, make a decision, and gain more experience. There is no such thing as perfect. You cannot think your way into perfection, just into action. You can't think yourself into perfection, just into action. What action are you taking? And that's everything. That's with your clients. That's with creating a more fulfilling financial stability and security for them, for yourself, using real estate, creating more balance, creating more joy, whatever that is for you. Do that this weekend, because I know we've got some interesting real estate stats to talk about letting into this weekend.
We do. And I wanted to go back to the goal setting, but it's right now, you can't focus on the outcome. You have to focus on your activities. And so what activities are you focusing on right now in order to get more business through the door? And I'm definitely going to spend some time this weekend going through and revamping my goals, because I need to go through and pick up business, because there are fewer transactions happening this year, and there are fewer transactions that will be happening through the end of the year. And so what am I doing to make sure that I'm getting enough transactions through my pipeline to ensure that I've got enough income going on? And so it's definitely hitting us all across the board right now in terms of how much income we're getting, but it's definitely a shifted market. And we're going to talk more about that here in just a couple of seconds. And so, as you know, our shift really started happening back as we went through Easter weekend, and the market hasn't necessarily recovered so much since we went through since we've gone back through several different holiday weekends. And so looking at what's been happening over the last couple of holiday weekends, we've had several that have come through since Easter. We've had Memorial Weekend. We've also had Juneteenth weekend for the first time. And now we've got 4th of July coming up upon us. And we watch our showing activity steadily drop as we go through each one of those different particular sets of each one of those different 3-day holiday weekends. Now, this data covers June 22nd through June 28th. And so I'll be going over just this last week of data. And as you can see, as we go through and we look at our heat map for the inflow and the outflow of business, I've tacked on yet another blue row indicating that the market is cooling. You really need to be spending time setting seller expectations right now that you're not likely to be under contract in that first weekend anymore. There was a call that I had this last week where I had to talk a seller off the ledge that had a $2 million listing in Wash Park that was on the market for 4 days without any offers. And that market, it's not
For
that it's
how many
dry
days?
for 4 days.
4.
4 days.
I'm just making sure I heard you
Yes,
right.
4 days
Okay.
for a $2 million listing in Wash
Okay.
Park. And they were expecting to be under contract in that first weekend. And I had to bring up a bunch of supporting data to show them that, you know, the market has cooled substantially over where we were back in January and February. I just had a text message from one of my really great clients, and they asked me, you know, will you send me the reports for March so I can show people the difference now between what was happening back in March, so that they understand the difference between the two different markets. And this really speaks to how the market has cooled since Easter weekend. And it's a combination of buyer fatigue and interest rates going up that have knocked a lot of affordability into play, where there's not as many transactions that are happening right now. Last year, we were very fortunate. We had an extended selling season because interest rates were so low that it really did stretch out until just after July 4th weekend before the market really started to cool. And so this year it was April that our market cooled. And so it was with that catalyst of interest rates going up, it forced a lot of buyers into our market earlier this year. And so a lot of our demand was absorbed early this year and created such the chaotic market that we had, where we were seeing $100,000 over asking price and a lot of different offers. And again, looking at what's been happening over the last couple of weeks, this blue line represents our active inventory. And as you can see, it's gone up quite drastically. Back here in January and February, we only had about 1,000 active listings for sale between both attached and detached residential. Well, now we're sitting at 5,000 average daily active count. And so this week, again, we had another going into this weekend. We're sitting at nearly 5,500 active listings going into this weekend. So we're adding about 500 new listings to our inventory each week that aren't going under contract in the first weekend. I'm hearing more often weekend 2 or weekend 3. And I'm hearing that people are making price reductions quite a bit more frequently. I always gauge it off of social media feeds where I can see price improvement, or this listing made it through the weekend, bring your FHA and VA buyers.
Right.
And so I'm seeing a lot of those posts coming through, and a lot more open houses to try and stir up activity to get these people through these houses. But our active inventory is going up pretty consistently by about 10 to 15% each week for the last 4 or 5 weeks in a row. And so this is inventory that we've been needing, that we've been begging for 2 years. And so take relish in the fact that the market that we've wanted is calmed down quite a bit. And now you're not at the mercy of what hits the MLS every single morning, and you're not trying to run out at lunchtime to go and show a property, but maybe you're back to showing property on the weekend and you're able to show 4 or 5 new listings in the market rather than showing only 1 or 2 at a time. And so hopefully that helps you reset some of your expectations around your calendaring and regain some of your composure back around your life, and you're able to have more work-life balance in light of having more inventory in the marketplace.
So quick question, the numbers on the right, that's months of inventory.
That's months of inventory.
So although it looks like we're skyrocketing in the inventory that we have, we're still less than 1 month of inventory here in the Denver market.
We had a surplus of buyer demand that happened back earlier this year that we're still trying to work out. And so I like to think about it as like when you see a big snowstorm that comes through and all the plows push all of the snow to the center of the parking lot, and there's that big melting mass. And even though all the snow is melted off of the grass, it's still melting in the parking lots for a week or so after that. And so we've got the big snow mass that's trying to melt itself down right now. And it takes a little bit longer to do that than just the regular stuff that comes off of the grass. And so right now we're sitting about 0.9 months worth of inventory, which is up from the 0.2 months worth of inventory that we were sitting at back in January and February. And so again, the market is trending towards a balanced market. It's nowhere near a balanced market. So let's not, I've seen a lot of social media posts about saying that now we're in a buyer's market. Don't say that.
It feels
Don't say that.
It feels like a buyer's market because the buyers have, but it's just changing.
It's a matter of perspective in such a short period of time where you were bidding hundreds of thousands of dollars over asking price to where now you're coming in at a full price offer in the second week, or maybe you're able to maintain your inspection resolution deadline and not have to come up with an appraisal gap, or you're able to get some concessions or seller down payment assistance. And so again, you have more negotiating power right now as a buyer, which is why it's super important where if you were a buyer back in January and February and you got knocked out of the market because it was too intense for you to try and compete and you couldn't make up the appraisal gap, or you couldn't let go of some of those contract date deadlines, that maybe now is a good time for you to circle back, because again, the long-term enjoyment of home ownership is much more important. Whereas if you're renting, you're paying 1,000% interest versus, or 100% interest.
It feels like a
versus versus if you're buying a home, you're paying 5.5%, 6% in interest. And even though interest rates are still higher, long-term investment investment in real estate is a good thing, and it's your best hedge against inflation.
I mean, this really is that opportunity to call all those people that you did lose to renting again.
Circle back to those
6
folks.
months ago, a year ago. I mean, we
Circle
have
back
that
to
rent
those
buyout
folks.
program where we're partnering with our realtors to help you do that. Because you're right, you're paying 100% interest rate, but they don't think like that. And it's cheaper to rent, right? So I can't get over this, but this is the opportunity where it feels like it's more towards a buyer's market, but still it's not. And which is also helpful for the appraisal gaps. Just to throw that one last piece in here, we're only seeing less than 5% of appraisals come in under, right?
That's great.
So it's just not really happening right now.
Yeah.
So if you are competing for a home and there are still homes that you're competing for, that appraisal could very well, Ashley on my team just went under contract 30,000 over asking. The appraisal came in 3,000 over that. So
great. That's wonderful. And so again, maybe you're not having as many appraisal issues now because we're getting back into balance with our markets where you're not chasing these insane numbers anymore. Pending transactions this week went up by about 2.2%. So a slight rebound after our Juneteenth weekend. We're not really seeing that rebound coming back after these 3-day holiday weekends, like what we saw last year, where there would be a dip in our activity over 3-day holiday weekends and the market would rebound. But we're actually seeing this slide, and this next graph really demonstrates that. And this is the odds of selling. The odds of selling is basically where I take into account all of the available listings for sale in a given week versus those that go under contract and or close, and I project it forward for a 4-week period of time. So this projects what the likelihood is of you going under contract and closing in the next 4-week period if you put up a new listing. And as you can see back here in January and February, we were sitting at 87.3% odds of selling, whereas now we're down to 64.8% odds of selling, which is where we were pre-COVID. And so we've returned back to where we were pre-COVID, to our numbers kind of calming down and getting back to a more normalized market that we're accustomed to here in Metro Denver, and more normal or average market, not a balanced market, but a more normal or average market. And so with 64.8% odds of selling, it's still higher than what we were experiencing pre-COVID by about 2 or 3%, indicating that it's still a great time to sell if you're a seller in this market, but it's not the craziness that we were experiencing back in January and February. So you have to reestablish what those seller expectations are, that you might not get multiple offers, that you might not go over asking price, that you might not be under contract in that first weekend, and really pull back in what those expectations are for your sellers. Also, if you're using comps that went under contract back in January, February, and March, that you've got to pull back by about 5 to 7% in your asking price at this point, because that's what the market is dictating. We've seen the amount of price reductions really drastically increase in the last couple of weeks. Now, this graph shows what percentage of balance we're at, and we're still only sitting at 15.3% of a balanced market. If we were to get to a balanced market, we'd need to have about 33,000 available homes for sale in Metro Denver, whereas we only have about 5,000 homes available for sale. So we're still drastically short on inventory here in Metro Denver, far from a balanced market. So we're not expecting a market correction to occur. At the current rate of transition, it's still going to take 6 months if we continue adding 500 houses each week to our inventory to get up to that number. And so that's still a really long number. We have a big inventory cushion before we get to a point where we're oversupplied with homes that would indicate a larger market correction if we do go into a recession. If we go into a recession, again, that's a good thing because it'll slow down the economy, and interest rates are likely to drop at that point, which would increase buyer demand. And so again, it's just not likely. If a homeowner finds themselves in a level of distress at this point, they're still able to list their home for sale, go under contract fairly quickly, and walk away with all of that equity that they've gained over the last 10 years, or even in the short term, just the last 2 to 3 years, and get out from underneath of that home. And so again, it's still a great time to sell. If you find yourself in distress, you can get out from underneath of that very quickly.
We have double the amount of equity in our homes than we did in the height of the market before the bust. Double the amount of equity.
Double the amount of equity.
That's options.
And so again, you're not going to find those short sales, foreclosures, or HUD homes making their way to market, because again, we're able to sell them in a very hot market. And banks are a lot more willing to work with sellers right now that find themselves in some sort of distress, because they don't want to hold on to that inventory either. And so again, we're far from a market imbalance. We're not expecting a market correction to occur. Based off of showing activity last week, there were about 14,000 total showings that were set, or it was about 3 shows per property per week if you put up a new listing last week. And that number is down from where we were back at our peak in January and February, where we were looking at about 24 or 25 shows per property. I had an interesting question come up this week that asked me, well, how many buyers do you think are available in the pool right now? And I was like, well, based off of roughly, 15 to 20,000 showings, and if they look at 3 to 5 properties each week, that means that we probably have about 5,000 buyers buyers in the pool right now.
Mhm.
And so that means that we still have more buyers than sellers in the market. And so again, that's kind of my best guess as to how many buyers are in the pool right now, looking at properties. But again, it's about 3 shows per property per week. And so again, resetting those seller expectations about how many properties or how many showings you're going to get over that first weekend. Now, looking at the number of shows to go under contract, it's still about 12 showings to go under contract. So if you've got 3 shows per week and it takes 12 showings to go under contract, we're looking at about 4 weeks. And so this information is good for you if you're trying to figure out how long before you make a price reduction. We have strike 1, strike 2, strike 3. Strike 1 is, if you didn't get 3 showings in the first week, you might not be in your target price range. Strike 2 is if you've had 12 total showings and no offers, then that might mean that you're not in the sweet spot in the market. But if it takes 3 showings a week and you're getting 12 showings to go under contract, you could be on the market as long as 4 weeks before you get those 12 showings through. And so you don't want to cut your nose off to spite your face and make a price reduction too early. And so I'm saying wait until weekend 2 or 3. Don't make a price reduction weekend number 1 if you're not under contract that first weekend, because it's taking longer to get people through these houses because there are fewer buyers in the pool right now than what we had back in January and February. Median days on market this last week, we're holding at 7. And so we're up from that 4 median days on market where things were under contract in that first weekend. People listing on a Wednesday, going showings on Thursday, Friday, Saturday. If things were under contract by Sunday night or Monday morning, was 4 median days on market. Now we're looking at closer to 7. That number is holding there pretty fast. And so we've seen median days on market going up pretty steadily for the last couple of weeks now. And so homes are spending a little bit more time on the market. Price reductions, it was nearly 1 out of every 3. So it was 29.3% of all the homes that went under contract last week made price reductions. So this is price reduction season, and we need to know how much of a price reduction we need to make. And the size of the price reductions keep going up. And so we actually saw, and I need to rescale this graph so that the numbers actually show, but the average price reduction was about 6% this last week. And so again, price reductions are definitely on the rise here, with people making about a $46,000 price reduction off of the top, which is nothing to shake a stick at. Those are pretty significant price reductions. And in previous market shifts, when we weren't sure what was going on, what I would see is more widespread price reductions, but at smaller amounts while we chase the market down. Right. People seem to squarely know where they're misplaced in their pricing, and they know that they're having to reduce their price more drastically to get in front of the market. And so it's getting 6% off of that original asking price to go under contract. So that's really significant.
And are you seeing it more localized to specific areas? Because I know you kind of map some of that.
Yes, I do. And so I see it more localized towards those right in central Denver and then the far outer ring of Metro Denver. I see it more high priced communities where I'm seeing where the average price is over $750,000. I'm seeing more drastic price reductions at higher price points right now.
Because I'm already seeing price reductions leading into this weekend. And that scares me because I know everything we keep talking about is we know that the buyers are going to be lower this weekend.
Yes. And so again, what happens over this 3-day holiday weekend going into Independence Day weekend with July 4th being on Monday is that our showing activity drops way down. It's going to drop by about 40% going into this weekend. This is a major summer holiday weekend. We'll see pending transactions drop by about 40% for July 4th weekend. And so I typically tell people don't list over 3-day holiday weekends, and also don't make a price reduction over these weekends because you're not sure if you're going to get enough people through that house to ensure that that price reduction was successful. And what ends up happening is with fewer people that are out there shopping for those homes, you end up getting lower offers that come in on these 3-day holiday weekends as well for those buyers that are really serious and out there shopping because they really need to get into a house, but they know that they have the upper hand on these 3-day holiday weekends. So your offers are likely to be a little bit weaker over these 3-day holiday weekends.
So let them make the price reduction.
Yes, let them make the price reduction. You don't need to do that. And so again, here's the under $500,000 market. We saw this market cool a little bit as well. In this market, our inventory went up week over week by about 16.5%, and our pending transaction count rose by 11.6%, with our month supply of inventory being at 0.5. This market is on the rise as well. There's been a lot of downward pressure on the under $500,000 price point. As people get knocked out of higher price points, they have to look at lower priced homes in order to make a purchase. And so again, we don't see quite the same shift that's happening under $500,000. We had a slight rebound as we went into our 3-day holiday weekend. The odds of selling came up to 76.7% odds of selling. We're still only sitting at 7.4% of the inventory required to offset demand. We only have 933 active listings. We would need to be closer to about 12,000, 12,500 active listings to create a market imbalance. So again, no market correction coming to this segment. Based off of new showings, new listings that you put up last week, you should have had 5.6 showings, 5 or 6 showings in order to placate or to make sure that you've got enough showings going through those properties on your first weekend. And again, it's about 11 showings to go under contract. So you should be on the market for about 2 weeks for homes that are under $500,000. Median days on market came up, and we're holding at 5 median days on market now, which is up from the 4 that we experienced for the first 5 months of the year. The rate of price reductions increased a little bit. We ended up seeing that the price reductions was 20.8%. And so again, we saw about 1 out of every 5 homes that were reducing their price. Average price reduction in this price range was about $25,000, or about 5.5% off of their asking price. So again, significant price reductions even for homes that are under $500,000. In the $500,000 to $1 million market, again, this market is the most sensitive to what happens with interest rates. And so as interest rates start to bang around a little bit, if they go down like they have most recently, you could see a spawn of some additional activity that happens in the marketplace because people are trying to lock in at those lower rates. But again, the cooling trend continues post-Easter weekend, where we see this market becoming less competitive. In this market, we're now sitting at 1.1 months worth of inventory, which means that we're out of that multiple offer territory for most price ranges, because we now have more sellers in the market than buyers that are available to buy them. But again, 1.1 months worth of inventory is still considered to be extreme sellers market territory, considering that number is below 2. Our average daily active count came up by 11.8%. Pending transaction count fell by 1.3% this last week, but overall, again, 1.1 months worth of inventory. And this is the first time we've been over 1 month of inventory since we were back here in December of 2020. And so again, we have a significant amount of inventory that's made its way to market, fewer buyers out there that are purchasing those properties. The odds of selling fell a little bit this week. We were down to 62.1% odds of selling. In this market, we now have 17.8% of the inventory required to offset demand. We should be closer to about 18,000 available homes for sale. In the $500,000 to $1 million segment, this represents about 62% of our overall inventory in Metro Denver. New listings that were put up between 500 to $1 million should have received about 2.3 showings on them. And it was taking about 10 showings, 11 showings to go under contract. So again, you could be on the market for 5 weeks before you go under contract. So stretch out your price reductions. Maybe weekend number 3, make that price reduction to get enough people through that house before you decide to make a price reduction. We were at 8 median days on market in this market. So again, days on market are taking a little bit longer. It's now over a week. So we're not seeing all half of the properties under contract in less than a week. It's taking significantly more than that. In this market, it was 1/3 of the homes, just slightly more than that. It was 34.3% of the homes that went under contract last week had a price reduction. And the size of the price reduction was 5.8%, or about $43,000 off of the original asking price. For homes between $1 to $1.5 million, that cooling trend continues as we get deeper into the summer months. In this market, our average daily active count only went up by about 3%, but our pending transaction count fell by 14.9%, which is why our predicted month supply of inventory is now sitting at 1.5. So that means for every 1 buyer in the market, they have 1.5 homes to choose from. And so again, we have significantly more inventory than what we had back here in January and February. Back in January and February, we only had about 100 to 125 available homes for sale, versus now we have nearly 500 homes that are available for sale in this $1 to $1.5 million mark. The odds of selling hasn't dropped off quite as drastically as we get into the over $1 million segment. We're now sitting at 57.2% odds of selling. We saw that we're sitting at 16.5% of the inventory required to offset demand. 2.8 showings on a new listing that you put up this last week. Again, that's down from about 12 shows per property per week that you were looking at back here in January and February. It's taking about 14 showings to go under contract. So if it's 14 showings to go under contract and you're getting 2 or 3 showings per week, that means that you could be on the market for 6 or 7 weeks before you go under contract. So again, a drastic difference from what we were looking at back in January and February. Days on market stretched up to median of 10.5 median days on market. So we're getting closer to 2 weeks here now, with half of the properties going under contracts in 2 weeks or less. So I'm saying again, price reductions don't happen until week 3 or 4 in this particular price range. So slow down your rate of price reductions. Again, about 1/3 of the homes that went under contract last week made a price reduction, and the size of the price reduction was 9.8%, or about $150,000 off of their original asking price. So a significant price reduction. Once you go over $1 million, you're seeing about $100,000 price reduction. Yeah. And so it's 6 figures off of your asking price to make a difference. $1.5 to $2 million cooling trend continues in this market. Our average daily active count went up by about 6.8%. Pending transactions this last week jumped by 11.1%. So our month supply of inventory is sitting at 2.2 months worth of inventory right now. So for every one buyer in the market, they have roughly 2.2 homes to choose from. And that's been pretty consistent over the last 2 weekends. Odds of selling is sitting at 53.4%. This market is faring better than where we were pre-COVID. Pre-COVID, this number was sitting down at like 30 to 40%. So it's still about 20% higher odds of selling. So this market hasn't dropped back down to where we were pre-COVID, like the $500 to $1 million segment has. In this market, we only have 18.1% of the inventory required to offset demand. So we're not looking for a market correction there. We saw a bump in showings that happened this last week for the $1.5 to $2 million mark. So we're sitting at about 2.1 months worth of inventory, and it's taking about 20 showings to go under contract in this market. So again, if you're only getting 2 showings per week, and it's taking 20 showings to go under contract, that means that you're looking at about 10 weeks on the market before you go under contract. So you might not want to make a price reduction until you've been on the market for a month or longer before you decide to make that price reduction. Median days on market was 8. So it actually dropped down this last week. So about half the homes were under contract in 8 days or fewer. And about 21% of the market made a price reduction before going under contract. The size of the price reductions dropped way down this last week. It was about a $71,000 price reduction versus what we had seen in the last couple of weeks. We've been hovering around about a 7 to a 9% price reduction. This market this week made smaller price reductions. So we're probably seeing that people are pricing their homes more strategically as they get into the market for these homes that are at higher price points, where they're not pricing them as aggressively as we saw previously.
Well, they don't want to drop it 150,000. That
no,
hurts.
No, it does hurt. And so
Definitely hurts.
I'll stop my share. We'll go ahead and answer some questions here. And so in the chat window, is anyone saying that sellers are open to considering offers from buyers with contingency, conditional sale? Yes, definitely. I'm definitely hearing that there are more of those contingencies that are happening out there in the marketplace, where it's definitely, if it's been on the market for weekends number 2 or 3, that if it's a home that they think is competitively priced going into the next market, that they're more willing to accept a contingency, unlike what we saw back in January and February.
We're seeing a lot of them. A lot of our contingencies now, if it's a second weekend home that's been on the market, we're getting them, which is such a blessing.
Yes,
such a blessing.
That's definitely. I've been hearing a lot of buzz around sellers offering a buy down the interest rate after the first weekend on the market. Are you seeing that? And so that's a Nicole question.
I'm going to be talking about the 2-1 buy down and a little bit more structure behind the video that I sent out yesterday. So we are going to be talking about that. It is one way to negotiate instead of going straight to a discount on the price, especially if you follow Megan's rule and you don't want to do it this weekend, then don't. Offer the 2-1 buy down first, offer some other alternatives before doing a price reduction.
Next one was Atlanta Fed Q2 GDP now just fell negative 1% from the plus 0.3%. It's looking like 2 consecutive quarters of negative GDP. So a recession is seeming to be more likely as this time goes on.
So let's bounce against that just for a second, though, because a lot of people will debate. You've got a lot of economists. Some economists think that we are already in a recession based on the fact that the GDP was negative the first quarter. The expectations nationally of the GDP first look second quarter is due out in 3 weeks. I know Atlanta is ahead of that a little bit, but it's due out in 3 weeks. So we're going to see, is there a second quarter of negative GDP decline? So if there is, you could say that it is a recession. And some will say that the first quarter was really due to supply constraints, not reduced spending, which really defines a recession. So there's debate on that. Ultimately, there is a group, part of the federal government, that determines that we have hit a recession and that we're out of a recession. They measure both. But the thing is people are acting like we're in a recession. So decisions are made like we're in a recession. So ultimately, you create the reality. And I think whether or not they decide that we are in a recession or not, I think that people are acting like we are in one.
Yes, I would agree. And so the next question was, can you show time on market for the ultra luxury market, like 3 million, or I think you meant 3 million or more? That's something that I can only measure on a monthly basis because I don't get enough transactions through, but median days or average days on market is about 21 right now for those homes that are 3 million or more. When I go through and measure that on a monthly basis, but I measure that information after a property closes. So that's more likely due to what the market was doing about 3-4 weeks ago. And so again, that could be as long as 30 days on market right now as we get into that multi-million-dollar market. And it looks like Lindsay Benton just raised the roof too for that 2-1 buy down. So again, thanks for all of your comments and questions.
And we have one on Facebook. So how do you reply to people who are seeing these price reductions as evidence of the housing market crashing?
This goes through and happens every year. We have a boom cycle and we have a bust cycle. And the boom cycle happened early this year. So the bust cycle where prices fall back happened earlier, but it's a seasonal reduction and those homes were likely overpriced to begin with, coming down into something that's more natural. But we end up seeing a fallback on our average sales price every year, July, August, and September. It just happened earlier this year. So if we happened earlier this year, that means that our pricing could stabilize earlier this year as well, indicating that 3 to 5% pullback in average prices. You pay premium prices when you purchase a home between January and the beginning of April every year to have the favor of moving into that home over the summer months versus the summer months when more inventory comes on and having more buyers that go under fewer buyers that go under contract as we get deeper into those summer months. This is part of a very natural cycle that we always go through. It just happened earlier this year because interest rates went up. We ended up seeing that those buyers were absorbed earlier this year.
And it's perspective, right? I think that's going to be like my word for 2022. It's perspective. Looking at your charts, if I go back, now yours has so much data on it. You have 20, 22, 21, and 20. If you could somehow squeeze 2019 in there, which we wouldn't be able to read it if you did, you'd see that we're where we were in 2019 on a lot of these data points, right?
And that was when interest rates went up to 4.5% for the first 6 months of the year. We ended up seeing that there was negative appreciation year over year for January and February of that year because it was an adjustment to that higher interest rate and an adjustment to affordability. And so again, what ended up happening is after March, we ended up seeing our appreciation start to increase again month over month because we hit where the hot spot in the market was again. And so people adjusted to those higher interest rates, and people still have to buy and sell and move and make transitions in their life regardless of what the interest rate is. And so we still see these properties that end up transacting, even though interest rates are higher, there's an adjustment that has to go in.
And Steve just popped up. Are the Fed still planning on raising the Fed rate? And 100%. Really, the question is will it be 50 bips, 75 bips, 100 bips, which is 100 bips is 1.1%. And most people are thinking that it's going to be the 75 bips that it was last time. They were talking about raising the rate 5 times this year to control inflation. We're already starting to see inflation is calming in the European Union. That actually rolled over and gave us some better interest rates a couple of days ago. We're also seeing in some of our manufacturing numbers that we're starting to see a slowdown in prices. I'm going to show you some of that I'm not going to talk at all about the Fed raising the Fed rate because right now it's really a question of what do the next 2 times say. I don't know that there'll be 5. By the time they do the next 2, they might lean more on quantitative tightening to do more of the heavy lifting for them because they might have done enough of the work. It won't, if they do 75 bips, the Fed raising the Fed rate won't move the market because that's what we expect. Remember, the markets don't move based on reality, they move based on expectations. So if I don't know what to expect, or if it doesn't turn out to be what I expect, then the markets are going to move drastically. If they just roll the 75 and they're doing what we want them to do, you might even see a reduction in interest rates because the market is feeling like the Fed is actually accomplishing the goal it set out. So I'm going to go ahead and put my screen share. I guess I could have been doing this while we were talking into presentation mode, share my screen and get this going for you guys on the economic side of things. So let's do this. So screen 2, PowerPoint. All right. So as we're looking at this next year, and I'm sorry, this next week, if we're talking about what happened this week, with the feds, I found this fantastic Freddie Mac report that I want to share with you, with really some great shareables, answering the question that we started talking about on Facebook is, how do I answer the question that we're not going into a bubble? So much of it is about perspective. We got to remind people that what we just came out of was not normal. There was nothing normal about 2020 and 2021. We talked about it the entire way up, right? And now we're talking about it on the way down.
Yep.
So you can't quantify, is this relative to last week, last month, 6 months ago, and say, are we heading into a bubble? What you have to do is put it in the perspective of, where are we with the housing market? And with everything that you're reading with cryptocurrency and with the stock market, as I mentioned earlier, the first half of the year is reminiscent of 1970. You really start to think the entire world is falling apart. Why wouldn't you, with everything going on with Russia and Ukraine and oil and the prices of everything and your stock market? I'm not feeling wealthy, right? I mean, that's the whole thing. If I'm not feeling wealthy, whether or not I had any intention of pulling that money out of the stock market or my retirement account doesn't matter. It's about feeling wealthy, and I'm not feeling it right now based on everything that's going on. So last week we talked about Powell's senior moment, and I really did love that, because he really is kind of going back on some of the things that he said, where he said that it was more likely than not that we were going to achieve a soft landing. And I was like, you know what, I never really said that it was going to be easy or straightforward, that we might actually trip into a recession. He's just setting us up. So we talked about that last week. Here's another quote from this week. I'm really starting to enjoy him, because he just keeps putting that foot deeper in his mouth. And I really like him. And that's what is so frustrating. So he said, we understand better how little we understand inflation. Mr. Fed Chair, I don't want to hear those words coming out of your mouth. I want you to understand inflation and how to control it. That's what we're all relying on you for. It is your job. You have two jobs. I tell this to Peter all the time. You have one job. It's a different job every time I tell him it, but he only has one job. Mr. Fed Chair, you have two jobs. You have maintaining employment, jobs for those who are seeking it, and controlling the prices Americans pay for everything that we purchase. Two jobs. Inflation. So how do you paraphrase that? So let's put that into English. So we're doing a lot to fight inflation right now, maybe more even than we ever have before, but we're not sure if we understand it. So maybe we'll figure out that we didn't do as much as we needed to, or maybe we'll figure out that we needed to do more. So we're not as much. And really, it's just an open question mark. What is going to happen next? But we are seeing some results. Too much, too little. That's the question. Did he already do too much? Was the 0.75% or the 75 bips that he did? Are we already seeing a decline in retail spending? We're seeing it softening, just like in the real estate market. We're not seeing all the economic indicators go into recession yet. And that's why I don't think the first quarter is an indication of starting the recession. I think the first quarter was due to supply constraints. I think if the second quarter we see a reduction in retail sales, I think that's going to be more of the indication of the beginning of the recession. And I think the third quarter, and where we might actually see us go into come September, we might actually see employment switch. And if we start to do that, that is the telltale that we are entering into a recession. We haven't seen it yet, and I'm going to show you that in a minute. So the PCE came out this morning, hot off the presses. We have a headline PCE of 6.3. If you remember, a couple weeks ago, we came out with the CPI. The CPI is a consumer price index. The PCE is the Fed's preferred measure of inflation. And the PCE and the CPI measure the exact same data set. So what's different? Well, they come out from two different organizations. They're two different set of indices on the same month. So both of these are measuring the same month, yet the PCE, which is what the Fed is watching, is 6.3. It's over 2% lower than what we're feeling as consumers, because that CPI is really measuring how much is that gallon of gas costing you at the tank? How much is your medical deductions costing you? How much is your wallet feeling it? Whereas the PCE looks at more of an enterprise United States level. So they're actually showing that it's 6.3. The headline, they're showing that it's just under 4.7% on the core. That removes food and energy because that's something that the Fed can't control. So they're going to remove those two, and they're going to talk about what they determine the inflation numbers that they're fighting. If we're seeing this continue to decline, remember also it's a respective measure. So we're looking at comparatively to last year. So you'll have some volatility in that. But if we see this continue to decline, that's where we'll see the Fed say do one more, two more, and then maybe put on the brakes over the 5 increases in the Fed rate that they had proclaimed earlier this year, a couple months ago, last month. I'm losing time. It doesn't matter. Oh, obviously, because of inflation, the confidence is at its lowest level. So Michigan puts out the index of consumer sentiment. This number is at a 50-year low, not a surprise. And of course, that's going to move over to spending. How much are we spending? Personal spending is at its slowest growth in 5 months, but it's still up. This is what I'm talking about. So when I look at the first quarter GDP, I don't really see that that was the indication that we started the recession, because spending, personal spending, consumer spending is 70% of the GDP. Yet we saw a decline because we had such a constraint on supply. We're still spending. Americans love to spend. We're still spending. We're spending a lot less. Really interesting, because of all the supply constraints and because of the big retailers trying to gather up enough inventory to satisfy the demand. Now we have too much stuff. Now we have Americans, maybe we have too much stuff. Maybe we're not buying as much. Our personal spending is down, but retailers have too much stuff. That is going to be really interesting. Of course, it's affecting their growth numbers, their profitability, and of course, what they're selling their stock for on stock market. But it's also affecting you. You're getting discounts. Go shopping this weekend. I'm telling you, buy a house. Everybody should list their house this weekend.
Yes. Well, not this weekend, next weekend.
Okay.
Next weekend.
So buyers, I'm talking to you. If there are sellers that are still on the market this weekend, this is the weekend to take the opportunity. It is also the weekend to go and get the mattress, the TV, of which Target has an abundance of, because as it turns out, those people that were stuck in COVID in their homes watching TV aren't doing that as much anymore. So they have too many TVs. So if you want a new TV, go to Target. If you want clothes or cosmetics, go to Target. They're doing a massive sale. They have too much inventory. This is going to help, ding, 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 inflation, because as those retail prices come down and sales continue to go up, we're going to see that inflation tick down. Now, not everything can be controlled. Remember, energy and food cannot be controlled. So they're going to strip that out. They're going to look at the core, but some of this is, and some of this is, we're going to see some price reductions. This calming, it's not going to go from up here to down here, but this calming slight ticks downward is what's going to give our market a little breathing room and create an environment where we're going to see slightly better interest rates enough to take advantage of it. And that's what we're seeing. And I'm going to show you that in just a minute. Personal incomes actually rose, mostly just due to pay increases, but they rose just a little, and they're not keeping up with the 0.6% month over month PCE that we just looked at. The number we just looked at was year over year. 0.6 is the month over month, and so is the personal incomes going up 0.5%. Unemployment. So the initial unemployment claims is when somebody is laid off and they go file for unemployment. So that number was positive in our favor. It was lower, 2,000 again. So week over week, last week it was an improvement of 2,000. This week it's an improvement of 2,000. We have not hit the bottom, and in my humble opinion, we have not started the recession yet, because unemployment is the tick. So right here, the beginning of every blue line recession, you're seeing the unemployment tick up. That's going to happen. We're seeing a lot of layoffs. Technology is seeing a lot of layoffs. I know we just had another lender close their doors on Friday. That was a massive layoff. Flagstar is just laying off more people. I know that Zillow is laying off folks. There are other real estate and lending companies, technology companies that are laying off. We all ramped up our teams and our companies over the last 2 years. Mm-hmm. We have to right size. We still have 11.4 million job openings. It's not like there aren't job positions for those people. And the initial weekly unemployment claims are telling us that. They're telling us if people lose their jobs, those people are quickly getting other jobs. Or maybe they're just removing themselves. They're older, they're ready to retire anyway, although don't retire in a down market year. It's kind of really hard to do that.
Mhm.
It's a down market year. But what's doing really well is, of course, housing. And this is where we're talking about some of the stats, some of the perspective that we can continue to give strength to our conversations with our buyers and sellers, right? Talking about the fact that while the stock market and cryptocurrency isn't allowing us to feel wealthy, just don't look at it. Do like I do. Just close the door. I look at real estate all day. It's a long term.
Not day to day.
Oh, it makes me shiver. I don't want to look at it. All right. So home ownership gains. So last week, if you missed last week's presentation, we talked about the actual CoreLogic came out with their net equity gains report, and it was massive. I mean, we just talked about the fact that it's double, the net equity is double what it was in the height of the market before the housing bust in 2007 and 8. But we showed all of that last week. Case-Shiller came out with their appreciation, and so does FHFA. Now, this is dated, no doubt. I mean, we're almost done with June, and I'm showing you April data. I get that. But we're going to continue to see this slightly slow down. It's not going negative. It's not retreating. But that's when it happened, when we started to see. In April, remember, is when the interest rates went above 5%. So we start seeing the slowdown, and we will continue to see that. Remember, the appreciation reports are always a little dated because they are singular homes. Each time that singular home sells, they're marking how much that home went up or down, and then tracking that nationwide by home, by metro, by state, by the nation. But in April, we were up 2.1%. Annually, it was 20.4. That had gone down just slightly from 20.6 in March. As of April, this was the second highest on record. So it was a 2.1%. So the average month over month for April is 1%. We saw a 2.1% increase in April. It is about perspective. When we look at all of the comparative years and we look at where we still are for 2022, we've still given our homeowners an incredible opportunity to build real wealth. We've created a challenge, of course, for first-time homebuyers to get in, which is where we're constantly looking for ideas and strategies to create an entry point for them. But we have to keep the housing market in perspective. It's not quite the same as losing value in the stock market when we see a slowdown of equity growth in the housing market. So prospectively, Denver's appreciation in 2022 is 8% higher than it was year over year in 2021. So it just continues to show how strong we came into this year, right? Really strong year. So even if we give some of that back, we're still going to land in the double digits for appreciation for 2022. Again, what you said is seasonal. We expect this to happen anyway.
It happens every year. It just happened earlier this year.
Absolutely. So this is, it's okay. It's okay. So when we see this, we have to put it in perspective. Some of these charts can help you put it in perspective. So we are slowing down slightly. If we compare the April to the March numbers, yes, we're 0.1% slower. Again, that's what the thing is. We're moving a little bit slower. We want that. It allows for first-time home buyers to get in the market. More inventory will allow us to continue to do that. FHFA just came out with their report for the same data. They're actually lower. They're at 18.8. A lot of this has to do with the fact that FHFA is just Fannie Mae and Freddie Mac. So it's only those loans that are inside the conforming loan limit. So they're not going to, it's not a lot of jumbos. You're not going to see a lot of high-end homes. So those lower homes, there's just less of them. Some of them are in metros. Of course, this is nationwide where they're not seeing as intensive appreciation as we are here in the Denver market. And then these numbers off to the sides, the lower number is the month over month, and the bigger number is the year over year based on the region. So FHFA is just a different way to show it than the numbers that I was showing up here with the Case-Shiller. All right. So Freddie Mac put out a report that said, what drove the home price? Like, is it over or is it done? Are we expecting it to cease and give it back? Or is this going to continue? So they put out a couple of graphs that I wanted to share that I thought were really powerful and can even be replayed on social media or certainly relate in the conversations that you're having with the very people that think we're entering into a housing bubble. So this just continues to show that with the light months of inventory, we just don't have a lot. We're going to continue to see high appreciation. It is a supply and demand. We still have less than 1 month of inventory here in the Denver market. That is going to, even though we're seeing the market slowing down, we're still seeing homes appreciate. We saw that on last month's DMAR report. We'll probably see it next week on the new DMAR report. We're seeing it in your numbers. I mean, we're seeing it in all the numbers. A lot of this, the continued support for the housing market is in the, will we have this massive increase of inventory due to foreclosures and short sales? We talk about this all the time, and the answer is no. We have 0.1% foreclosures here in Colorado. It's just almost nothing. And of course, you can just sell. You can just sell. We keep talking about that. So letting people know how much equity we have here in the Colorado market, how few foreclosures we have, how few short sales we have, the ability for for owners to simply sell and not go into foreclosure and short sale, not creating a massive inventory uptick. So that's the thing. We also have the number of 25 and 34-year-olds. There are now 18% more people between these ages than there were in 2006. So you have more people at the right age who are going to continue to purchase homes. That is going to continue to push demand. In fact, it's one of the reasons why I'm a little worried about what's going to happen when rates go down again. I mean, we could see a really big uptick in values of homes if we see a big demand pressure on those homes, because we simply can't get quite enough inventory to satiate the demand that we've got. The vacancy rate historically is also very low. And when you think about a home that's going to be abandoned, right? If you think about a home that's going to go into foreclosure or a short sale, it's probably going to be a home that somebody's not living in. It's probably going to be a vacant home, because the home that you're living in, you're going to do everything that you can to protect the roof over your head, right? And you probably have a lot of equity. You're simply going to sell it, but nobody just sells to save what? Because you're just going to have to go rent. You're not going to choose to sell the home that is providing a roof over your head. So a lot of the vacancy rates as we watch this also is a telltale, and we had a lot more vacancies if you go back to 2006, is a telltale of, will we see more of that empty, that shell of a home go onto the market because it's been abandoned, just not there. We also looked, Freddie Mac put out their first time home buyer share of their business, right? So Freddie Mac and Fannie Mae are conforming. So of course, if you've got move up buyers, you might have either cash buyers or jumbo buyers. So a lot of this makes sense. You have to put it in the context of Freddie Mac. So it's not the entire market. The Freddie Mac and Fannie Mae are saying, if I'm taking my data and I'm estimating what the national numbers would look like, they're still saying, look, we look really strong. But in this, Freddie Mac is saying our share of first-time home buyers of our overall portfolio is 45%. So we're still churning through those younger age groups that are still in plentiful, that are coming in and buying. There's still a strong demand. And another interesting chart that they put together was the number of renters who were between the ages of 25 and 44 earning more than $75,000. Those renters that are capable of buying. That's going to continue to push on demand because we have the ability to continue to sell. They're just waiting, which drives me crazy. But I get it, right? Home prices are higher, interest rates are higher. I'm waiting for the drop to happen. I'm waiting for the bubble to burst. I'm waiting for it to get cheaper. I'm waiting for a better deal. Whatever they're waiting for. In the meantime, they're renting. They're still renting 25 to 44-year-olds, massive number, 3.5 million of them who are ready to jump. What's inconsequential and what they did a deep dive on is the institutional investors. Those institutional investors are 4% of the market. And of course, with Zillow not buying as many, and we're talking about how much, but you still have these massive organizations, these BlackRock and these investors who are buying thousands and thousands of homes. So it's still, they're ruining the market. They're the ones that are pushing up all the prices. They're 4% of the market. That's really inconsequential to the number of first-time homebuyers. 45% of Freddie Mac's share of loans are all based on first-time homebuyers. It's these individual investors. Dang it, you and me and Megan, like it's us, right? It's those of us that are continuing to look for opportunities that are going to vacate our primary, that we're going to move into our new primary, turning that one into a rental, taking the opportunities of allowing for appreciation, allowing for principal reduction, allowing for ongoing income. Realtor.com just this morning came out with their active listing count. We watch Megan's numbers, I know that, but it was a perspective thing to see, here's where we are in previous years, here's where we are today. Yes, it feels like a lot. Showing them perspective, those people that think we're going into a bust, we're nowhere near the number of months of inventory that we need. Pending home sales came out. This is a national number, not a local number, but interestingly enough, it didn't come out very strong. It came out 0.7% up, but it came up. It was expected to be 4% down, negative. So pending home sales, meaning all of this is just saying it's a relative number. The housing market is still chugging along. People aren't vacating it because yes, it's less affordable, but they're not backing out entirely because they know that this is the path to wealth. This is the path to putting a roof over my head, that I'm not paying somebody else's financial future. The new home sales came out as well on Friday. So after our market trends, it ticked up slightly. You can see it right there. It actually rose 10%. That sounds like a great news. But remember, new home sales are only, or new homes are only slightly more than 10% of our entire market. And when you actually dive into the numbers, it's just not that much. So the months of supply, so this is the new homes months of supply. It actually went down slightly because some of those homes are getting off of the inventory. And we only have 0.6 months of inventory that we can actually purchase, that's actually completed. Over 2 months of inventory hasn't even started yet. It's dirt. And then the rest of it, over 5 months of inventory, is just sitting there waiting, just sitting there, whether it's lack of workers, whether it's slow supply, it's just in process of being built. Maybe it's buyers that had to back out. And so they're back out there and they're finishing the home and they're having to restructure. Whatever that is, we've got a lot of construction that's not quite yet filling the inventory need. So it's better to rent than buy. Oh, don't say that out loud, but that's what the headlines are saying. And that's what we had to continue to combat. I did our live on Tuesday with Ashley, our little marketing gal, and she, is paying $500 more a month to purchase over renting. She had to come up with, she bid $30,000 over asking. It's scary, but this is the opportunity. But here's your opportunity. Interest rates just went down. Just a little, but it matters, right? It matters on your monthly budget. So if you can take advantage of this, please, please, please call me this weekend. Buyers get out. The interest rates are lower. You can afford more. We're going to see inventory with sellers who really want to sell because they know that you are a very determined buyer. So they're going to want to make it work, unless you just offer them too ridiculously low. And then they're just going to think you're rude. So don't do that. But go in and be competitive. Take advantage of the lower interest rates and maybe offer the 2-1 buy down instead of a massive price reduction. Because I went through the numbers I sent it out yesterday. I did this whole video and I showed you where as a buyer, a 3 to 5% price reduction does not impact you nearly as much as cramming in a 2% lower interest rate for the first year, a 1% lower interest rate for the second year, knowing that we're heading into a recession and you can refinance into that lower rate using the $1,000 refinance certificate. And I like this a lot better than ARMs because ARMs can go up a lot. And if our recession doesn't give us a much lower interest rate, at least I know I'm locked in for 30 years at a payment that makes sense. So the one question I keep getting after Wednesday's video that I realized it didn't answer in the video, and I want to say it here, and then we're going to shut this down, is the fact that what's the cost, right? What's the cost to the seller for a 2-1 buy down? And I can calculate that for you very easily, but it's the difference. So it's not based on the purchase price, it's based on the loan amount. So it all depends on how much that buyer's putting down. So it's based on that loan amount and what that monthly payment is at the current market rate, say it's 5.875, and that monthly payment at 3.875 for 12 months, and that monthly payment at 4.875 for 12 months. I add up that difference, and that's what it costs. It's that easy. It's not a secret and it's not a crazy calculation. It's just adding up the difference, the 12 months at 3.875, the 12 months at 4.875. What is that spread or that difference between the current market rate of 5.875? Add that up. That's what it's going to cost the seller, because what you're doing is prepaying their monthly payment for 2 years. It's a phenomenal opportunity. Going through the numbers, don't miss. We're really getting close to selling out on our July event because we're having it at Columbine. So it's a finite space. We're going to be doing our market update on Zoom. So if you don't want to come join us, absolutely okay. You will not miss a market update, but then we're turning the Zoom off. We're turning Facebook off. Mike Sherrard's going to be there with a light lunch, and he's going to be talking about all of his tips, tricks for all of his processes, his systems, and his social media. It's absolutely a do not miss event, and we've gotten a ton of RSVPs. So I am very excited about that. So we'll see if we've got any questions. We've got just a couple minutes left. What do you think?
Do you think Powell is saying these things to help reduce demand so they don't have to actually raise rates as much? It seems like he's been telegraphing a lot recently to help reduce demand.
He's been telegraphing because he knows that the market doesn't like surprises. So he's trying to get in front of it to say, if he comes out at 75 bips or 50 bips or 100 bips, I want to preemptively warn the market so that we don't see these dramatic changes that we saw the first couple of times that we were surprised. I think he's learned his lesson.
Can you use a 2-1 buy down on a VA loan?
Yes. The only loan I can't use it on is jumbo. We can use it on conventional VA, USDA, and conventional. I said that first.
How do you register for the event at Columbine?
We will send everybody an email, and it's at the bottom of all my emails.
Awesome. Yep. So as a reminder, we'll be sending out all of the slides a little bit later today. Nicole posts hers in her Agent Ignite Facebook page. So make sure that you go ahead and follow that to get a copy of her slides. We'll be posting the recording there, and I'll be sending out an update with all of the tidbits that I shared with you for this weekend, headed into July 4th. So we hope that you have a happy and safe holiday weekend. And we thank you so much for joining us today. And as always, the reason why we do this is we want to make sure that we do provide our part so that you can better advise your buyers and sellers. And we hope that if you help you better advise your buyers and sellers, that in turn we'll get to see what our closing table. So please keep Fairway Mortgage and First American Title in mind when you go to your next transaction, and we would love to work with you. Other than that, have a safe holiday weekend. Thanks, guys.